So Jeff Bezos of Amazon once asked Warren Buffett that you are such a well-known investor, your investment philosophy or methodology is out there in the open. Why don't just people emulate you and become rich? And the answer that he gave Bezos is pure gold. What he told him is that because nobody wants to get rich slow.
What is the importance of starting investing early?
Inflation is silently killing you because it is reducing your purchasing power. If we do not start early and if we do not invest in appreciating assets, you will not be able to create enough wealth which would help you to sustain the lifestyle in those retirement years and live with dignity. Warren Buffett started investing at the age of 11. He made his first $1 billion at the age of 55. And today he's worth more than 100. So the entire compounding has happened after that. You will notice that for a very, very long period of time, nothing happens. And that is where you need to have that persistence or patience and discipline to keep at it. So let's assume that I'm giving you 1 rupee today and this 1 rupee will double every year. Can you tell me what this number would be at the end of 15 years?
15 years.
So it's close to 16,000. Now, let me ask you what this will become at the end of 30 years.
In some lakhs.
The number that it would become after 30 years is crore.
Welcome everyone to VK Talks. We are continuing our conversation with Ketan about the investing and financial freedom for the SME owners. So be with us, and before proceed, please like, share, subscribe our videos. Thank you very much.
Please note that all the views expressed in this podcast are purely from an education perspective and not recommendations. Investments in securities market are subject to market risk. Please read all of our documents carefully before investing. Please consult your own financial advisor for any investing decisions.
Okay, Ketan, you have I've gone through your one LinkedIn post about the behavioral issues. Could you more elaborate on that? What kind of behavioral issues, what things people follow in or do mistakes in investing?
Okay. So I think behavioral aspect of investing is a very interesting one and often neglected.
Okay.
We must give credit to a gentleman called Daniel Kahneman. He was an Israeli-American psychologist who won Nobel Prize for behavioral economics. Okay. And in his seminal book called Thinking Fast and Slow, he has spoken in detail about different aspects of behavioral finance. So I would urge all your listeners to go through that book if you are serious about investing. Okay. Now coming to your question about what are the behavioral aspects that affect one's investing journey. Okay. So first thing I would say is there are different behavioral biases. So just to give you a few examples, there is something called as the recency bias. So recency bias is something that we look at the things in immediate past and base our decisions based only on that, with an assumption that whatever has worked lately will continue to do so in the foreseeable future. Okay, and that's a mistake. The second one is anchoring bias. Okay. This happens with many people that they would have seen their parents or their relatives investing in certain way and believe that this is the right way to go about doing it. Okay. For example, in our earlier generation, the investment avenues were limited compared to what they are today. Okay.
Yes, absolutely.
So there were certain patterns that they followed. Okay. It's not necessary that the same pattern would work for the next generation. So this anchoring bias is something that prevents people from changing their perspective about investing, which can hamper their returns in the long run. Okay. The third bias is loss aversion bias. Okay. So it goes like this, that the pain of loss is far higher than the joy of gain. Okay. So what that means is that people usually tend to avoid booking losses in their investments and are usually very quick to book the gain as fast as possible. Okay. So what people tend to do is, they keep on holding on their loss-making investments, even if it is clear to them through the investment hypothesis that this is not working, just because they are afraid of booking the loss.
Okay.
On the other hand, if something is doing well, they make a mistake of, selling it early. Okay, by which they actually kill the future compounding if that asset is going to do well in the future. Okay,
Okay.
so this loss aversion bias is again very important, and it is also linked to something called as a sunk cost fallacy. So, what is sunk cost fallacy is the same thing that I mentioned earlier. That if you are aware that this is not working, you know, continuing to persist on it despite the data telling you otherwise is something called as a sunk cost fallacy. This is true in business as well. So, for example, let's say an SME founder is getting into a venture, okay, and after a point in time, if he finds out that it is not working out, persisting through it and putting more and more capital behind something that is not working is like putting good money after bad money. Okay, so
Okay.
this is more like the sunk cost fallacy that one should be aware about. Then Kahneman also talks about two systems of thinking. Okay,
Hmm.
the first one is a quick one, emotional, with a lot of speed, quick. Okay,
Okay.
but not without much thought. Okay,
Okay.
so there are two systems of thinking. One is quick, okay, without much thought as to what could be the consequences of the action.
Hmm.
Second is more slow, rational, and thinking about consequences. So he says that one should always look at these two systems of thinking and try to avoid the first one as much as possible. This is true both in business as well as in investing. Investing should never be based on somebody gave you a tip to buy something. Unless you do your own research and you are convinced and you build a hypothesis around that investment, you should not get into it. Otherwise, the probability of making a loss is very high,
Is very high.
right? So these are typically, the different behavioral aspects about it that are there in investing. Second thing is greed and fear.
Hmm.
We speak a lot about greed and fear,
Yes.
right? You would have heard these quotes called, you should be greedy when others are fearful, etc. Now, what is important over here is, to develop one's own approach of looking at things. Okay,
Okay.
the greed or fear for an investor should be personal. It should never be communal or what the herd is doing. Okay,
Okay.
and this basically helps you to sustain over market cycles. So just to give you an example, if you look at the history of Indian capital markets, if you look at last 30-40 years,
Hmm.
every decade, once it has happened that there has been a big correction or a crash in the market, to the
Yeah.
tune of 30, 40,
Yeah. Yeah.
50%. Okay, so it happened in securities market scam of 1992. It happened during the dot-com bubble of 2000. It
Hmm.
happened during global financial crisis of 2008,
8.
and it happened during COVID March of 2020, right? In recent history. Now, there is something called as a freak out behavior. What is this freak out behavior? And this is something that investors should be wary of.
Hmm.
Okay. What is a freak out behavior is that when, things are falling apart in front of you, there is a lot of uncertainty. Okay. You tend to sell everything at the lowest point of that correction.
Right.
Okay, and many a time this is something we call as a freak out behavior, because if somebody just takes a step back, right, and look at it from a broader perspective, if you read history, you will come to know that these are market cycles.
Right.
Okay, and when everybody is panicking, uh, you should turn greedy in
Hmm.
your own portfolio, right? Of course, it has to do with your overall asset allocation and your plan as well. But that is the time when you should actually be greedy. Okay. The other end of this is that when everything is euphoric,
Hmm.
right? When everybody is so gung ho about the future that everything is looking very rosy, everything is growing, and etc. etc. That is the time to be very cautious. Okay. So, these are two things where, your greed and fear play a very important role in an investor's journey. So, behavioral finance, I would say, is a very important subject which is often neglected. But eventually, over a longer period of time, the kind of returns that you will make has a very close relation to these, behavioral finance
Behavioral
aspects.
finance aspects. Okay. So, in your point of view, what are the financial mistakes you observe people are doing?
So, I mean, the common mistake is, investing without a goal. Okay.
Okay.
So there is no goal post, So whatever they are currently doing, if you are not aware where you want to reach, then, it will not take you anywhere. So investing without a goal is the first thing. Okay. Second thing is investing into something which is not suitable to their risk profile.
Okay.
Okay. That is the second one. The third one is thinking only about the upside and not thinking about the downside.
Okay.
Okay. So the approach that I spoke about earlier, first you look at protecting your capital and then look at a reasonable return, right?
Right.
Two things we have to observe over here is that when we are saying we have to protect our capital, uh, we should be looking at taking asymmetric risk.
Okay.
What is asymmetric risk is that the downside is protected, upside is open.
Right.
Okay. So that basically places you very well on this path. The second thing is, when I'm saying reasonable return, returns are never absolute. They are always risk adjusted, and this is very important. Okay, so this one should be mindful of this. So when I'm saying you should protect your downside, uh, we should have enough emergency funds at your disposal, right? You should be well covered as far as your health insurance and term life insurance is concerned. Okay, so that should take care of any in case of any eventuality, then you are protected. Because what happens is many a times, and this is unfortunate because people do not think about the downside. Let's say you are building a nice portfolio and you keep at it, you go about doing it very systematically, be very consistent, etc., and the portfolio grows. Okay, now let's say there is some adversity in the family or there is some calamity for which you need capital. If you have not thought about the downside, what it leads to is then liquidation of the hard built portfolio. Okay,
Right,
and that is the worst part. And what it does is that it kills compounding. Okay, so here let me also speak a bit about compounding. Compounding is something that is highly underappreciated as far as both the business as well as the investing domain is concerned. I mean, people fail to look what a good investment can do to their finances in the long run. Okay. So let's take a live example. So Warren Buffett, who is one of the best investors in the world, I'm sure a lot of your listeners would be aware or would have heard of his name. Okay. He is 95 years young as of today. Okay. Born in 1930, right? Started investing at the age of 11 and he said, I was late. Okay. I should have started investing early. Okay. So the saying goes. Okay. You would be amazed to know that today he has a personal wealth in excess of $100 billion.
Right.
Okay. Or even more than that. Right. But the interesting part is, if you look at his journey, okay, I mean, the investing journey, you would notice that he made his first $1 billion at the age of 55. Okay. And today he's worth more than 100. So the entire compounding has happened after that.
Right.
So it tells you two things about compounding. First thing is, in the long run, compounding is magical. Second thing is, you will notice that for a very, very long period of time, nothing happens. And that is where you need to have that persistence or patience and discipline to keep at it. Just another thought experiment about compounding that will illustrate the significance of what compounding can do. Okay, so let's assume that I'm giving you 1 rupee today, and I'll keep on giving, and this 1 rupee will double every year. Okay, so today 1 rupee, after 1 year it will become 2 rupees, after 2 years it will become 4 rupees, so on and so forth. Can you tell me what this number would be at the end of 15 years?
15 years, 1 rupee every year.
Yes.
15. So I think it must be.
So it's close to 16,000.
Oh.
16,000, okay.
Okay.
Now, let me ask you what this will become at the end of 30 years.
Around in some lakhs.
Okay, so the number that it would become after 30 years is 53.7 crore.
Oh.
Okay, now observe this. For first 15 years, you didn't see much, right? It was here, and then suddenly it went up. That is the nature of compounding. Okay, for that you need to give it time.
So what do you see common pitfalls in businesses and personal finances?
Okay. So, especially for SME founders, particularly, uh, I would say that first thing is that there is very little importance given to personal finances. The personal finances are thought about only when there is conflict.
Okay.
Okay, and family security is linked with business risk a lot of the times. Okay, so the first thing which is a mistake is that there is no segregation between business finances and personal finances. Second thing is, this approach of not paying yourself first. Okay, I see that with a lot of SME founders, wherein many of them do not even draw monthly salary. If they are drawing something, then those are arbitrary. Okay. Second is any drawdown that they have from the company, it's guilt ridden. Okay. At the same time, their mind is thinking whether I should reinvest this in the business or should I take out. Okay. And another thing is their risk is very concentrated because all their finances are linked to their business, right? In case of any problem, they have nothing to fall back upon. So there is not enough diversification. So I think the common mistakes that I see are investing without goal, not giving enough importance for drawing, salary or a payout from your own business, because after a point in time, the business starts owning you rather than you owning the business. Okay, both in terms of your bandwidth as well as your finances. Okay, the third thing is asset allocation. One should go about asset allocation very, very seriously, because a wrong asset allocation can set you back by many number of years, and that would not help you achieve your goal. Okay. So, for example, let's say somebody is younger, say somebody is 20, 30 years old, who has a long runway ahead of him or her, wherein, he will keep on working either in a job or in his own business, his or her own business, and his income would keep on increasing. Okay. If majority of his assets are tied in fixed income at that point in time, it will not help him create wealth, because it will hardly beat inflation. For creating wealth, you need to invest in assets and get your asset allocation in such a way that majority of your assets are tuned for growth when you are younger.
Okay.
Okay. As you age, now asset allocation is also age appropriate. Okay. It is based on two, three things. Okay. One is what is your income level. Second is, of course, what is the kind of risk that you are going to take. Third is what kind of liabilities that you have. Okay. And fourth is what is your goal.
Right.
Okay. So these are the things that I find which are common pitfalls, that people do not approach either the business or the investing through this lens, or the financial lens is something that is lacking. Okay. Then a lot of importance is given to quick wins. Okay.
Right.
Rather than patient compounding.
Okay.
Here I would like to, give you a very nice quote by Warren Buffett, which explains, what is the problem when there is a temptation for a quick win. Okay. So Jeff Bezos of Amazon, once asked Warren Buffett that you are such a well-known investor, your investment philosophy or a methodology is out there in the open. Why don't just people emulate you and become rich? And the answer that he gave Bezos is pure gold. What he told him is that because nobody wants to get rich slow. Okay,
Exactly.
so this is about the mindset. Okay, so I think that is what the mindset shift is, something that is very important.
So, Ketan, what is the importance of starting investing early? Can you explain on that?
Why it is important to do so is because you give yourself enough time,
Right.
and you need time for compounding.
Hmm.
Okay, that's a simple thing. But I think if you go beneath that, okay, let's also look at this in the current context. Okay, as you would notice, if be it a job or be your own business, especially SMEs, okay, the uncertainties are going up. Okay,
Yes.
the rate of obsolescence, the rate of regulatory changes. There are so many different factors that are affecting whether this business would be viable after 10 years or not. A lot of things right now are hazy. Okay.
Right.
On the other hand, what is also happening is earlier, the lifespan of people, which used to be say 10, 20, 25 years back, it is now going up.
Right.
Okay, because of medical advances, because of focus towards fitness, lifestyle, etc. So essentially what is going to happen is, what used to happen early was that people used to work till late and had a lower life expectancy compared to today. Now the situation is completely different. Okay, the uncertainty is going up, right? So the retirement age is shrinking. Okay,
Okay.
be it a forced retirement or retirement to do something of your own, or because if there is some problem in the business, or you would decide to shut down the business, right? These uncertainties are going up, and the timeline is shrinking. So earlier, if somebody used to work till age of 60, today he or she may be looking at working till age of 50,
Right.
right? But on the other hand, if like say 20-25 years back, the life expectancy was say 75 years, it is now pushing towards 80 years.
Right.
Okay, so the number of years in the retirement, or when your active income is not going to be there, are going up. Okay.
Right.
Now, the second thing in this, which is very important, is the lifestyle. Okay. So we are social animals, right? Nobody I have seen who would want to lower his or her lifestyle
Hmm.
on their own, unless
Exactly.
forced to do so.
Right.
Okay. So I have not seen anybody who is staying in a 3 BHK apartment and willingly saying that I want to shift to a 1 BHK apartment. Okay. Unless there is some calamity, right?
Exactly.
Now,
No one is
there are
thinking
two
that.
factors over here. Okay. One is inflation.
Hmm.
Inflation is silently, killing you, right? Why? Because it is reducing your purchasing power. Now, if we do not start early, and if we do not invest in appreciating assets which help you, generate returns over and above inflation, you
Hmm.
will not be able to create enough wealth which would help you to sustain the lifestyle in those retirement years and live with dignity. Okay, so
Exactly.
that is why it is very critical that you have to start investing early, considering all these factors.
Okay. Okay. So Ketan, what are the pillars for the financial prudence
Okay,
the person should have?
so the first thing is starting early, uh,
Okay.
remaining consistent through ups and
Ups
downs.
and downs.
Okay,
Third one.
third thing is getting your asset allocation right.
Okay.
Fourth thing is, if you are young, start investing in appreciating assets and not depreciating assets.
Okay.
Uh, Fifth thing is, have as much low debt as possible. You
Okay.
would have seen lately, because of social media and other things, people are going on vacations on debt. Okay, for that one Instagram reel or a post, okay, people are spending on debt. That is something they should totally
Avoid.
avoid, because debt is the enemy of compounding, both in business as well as in personal finance. Okay. Fifth thing is, do not forget risk management. Like I said, returns are never absolute; they are risk adjusted. So have a very keen eye on risk management.
Six.
On when you are going to go about doing this, uh, think about the downsides and upsides both. Do not just think about the upsides, because if you do not protect your downsides, you will have to let go of your upsides, and you will kill the compounding.
Right.
Okay. So I think these are some of the things that one should keep in mind. At the same time, I would also suggest for people to, be mindful about their spending. Okay. What happens many of the times is, in most of the families I have seen, if you look at it, uh, income minus expenses is equal to savings for most of the people, right?
Yes.
Now, this needs to be flipped. Okay. So the expenses should only be made after you have earmarked the money for savings. And
Okay.
that will ensure that you have the capability to invest consistently.
Right.
Otherwise, it becomes very erratic. Okay. So I think that these are the main pillars, I would say. But I think at the heart of it is having a sound financial plan, which would address all these needs, sticking to it, reviewing it from time to time. Okay. So that as to make any course correction, because when you are looking at a long journey, you have to keep on intervening from time to time to see if everything is going right or not.
Right.
It's not something like that you have just done it once, and that is the reason you would see a lot of the financial plans, don't help people, because they don't evolve along with them, and they don't help people to make decisions.
Hmm.
Okay, so I think these are the main pillars for investing for any person.
Okay. So Ketan, we will go have a rapid fire round for
Sure.
you. Okay. So, stock market, wealth creation tool or a gambling?
For a patient long-term investor who knows what he or she is doing, it's a wealth creation tool.
One book every one should read.
Okay. So I would say, since your audience is primarily SME owners, there's this book called Business Adventures by John Brooks.
Okay.
It's a very nice book for anybody who is doing his or her own business. As far as investing is concerned, there's an excellent book called What I Learned About Investing from Darwin by
Okay.
Pulak Prasad. This
Okay.
is an excellent book which will give you a very different perspective about long-term
Long
investing.
term. Fixed FDs or equity based investment for long term.
I would say it should flow from your asset allocation. Equity will give you growth. Fixed income will give you safety. But the proportion of that should be dependent on where you are in your life journey.
Real estate or stock market.
Again, difficult to give blanket answer. Between these two, I would say equity is liquid uh, and it helps you beat inflation in the long run.
Credit cards, tool or trap.
Okay, so as you would be aware, the credit card debt, unfortunately, in India is going up
Right.
as every other day. See, I would say if somebody is prudent about using credit card, by prudent, I mean if you are paying all your dues on time and not just the minimum balance, it is a good tool, but definitely not for sponsoring your lifestyle expenses beyond a point.
Okay.
Okay, you should be prudent about how to use it and paying your dues on time. Then it is a tool. Otherwise, it is a big trap because credit card debt is the worst form of debt that I have come across.
Okay.
Yeah, absolutely.
When should an entrepreneur hire a financial advisor?
So when he or she realizes that family safety should not be dependent on the business risk.
Okay. Your biggest investment mistake.
My investment mistake, I would say, is not starting early enough. I mean, not committing serious capital right from the beginning. It's
Okay.
something that I regret. And I would say for most of the investors, the common regret is that why didn't I start this early?
Okay. One sector you are bullish for next 5 years.
I would say discretionary consumption and premiumization.
Okay.
What is happening is, see, India today, if you look at it, our GDP per capita is around $3,000, thereabout. Okay. If you look at history of other countries, which have gone from developing to developed, okay, their GDP per capita has kept on increasing.
Right.
Okay. As your GDP per capita increases, the discretionary spends increases. So there has been a direct correlation. So people, instead of spending money on things, they start spending on experiences.
Okay.
Okay, and I think that would be a pretty big thing for India as India goes from India GDP per capita keeps on growing from here.
Okay. One habit that changed your financial life.
I would say, see, when you are investing, okay, there are two types of error that you can commit. Okay, one is error of commission, and the second is error of omission. Okay,
Okay.
so error of commission is something that you think that it is good,
Hmm.
but it is actually bad, right? And the error of omission is you think it is bad, but could turn out to be good. Okay.
Okay.
What I found out was that statistically, and it has been proven also, is that minimizing your type 1 error increases your investment success a lot.
What is the difference in SEBI RI?
Okay, so I think SEBI RI, this model, the key difference with others
Hmm.
is one is fiduciary duty,
Okay.
second is regulatory compliance framework,
Hmm.
third is well-defined fee structure.
Okay.
Okay, fourth is advisory offerings, so the control remains with the client. Fifth is customization, because for every client your services cannot be same. It depends on their own risk profile, their own goals. So I think it brings in an angle of customization, which typically is missing in other models, is what I would say.
To summarize the whole our episode, 2 episodes, we can say as first, start investing, pay yourself first, start early, and compounding matters.
Yes. So I think to summarize, I would say begin early, uh, focus on appreciating assets for creating wealth,
Right.
uh, try to reduce the debt. Okay. The fourth is get your asset allocation right, which will protect your downside, which help you get done upside. And when I'm saying downside, have adequate health insurance, have adequate term life insurance, build enough emergency funds which
Okay.
will last you in case of any eventuality. Planning for that. Uh, do goal-based investing. Very important.
Okay.
It should not be something that you are doing currently for a very long period of time. If you realize it later that this is something which could fall short of meeting my goal, time element is very crucial.
Right.
Okay, because then doing the course correction in the end uh, may not be possible all the time. And like I said, nothing happens overnight. You need to give it time. So rather than quick win, focus on rate of compounding. Okay, focus on the personal finances along with your business, because both will go hand in hand.
Exactly.
Right? See, there is this S curve. Okay, for any, be it a business or any enterprise. Okay, there is this S curve, right? So you start. This is your startup phase. Then there is a growth phase, and then there is a maturity phase. Okay, you need to allocate capital wisely for all these three, and your perspective for all these three phases should be different. Okay,
Right.
so having uh, capital allocation strategy for every phase, which is appropriate to that one, should be the key thing. For SME owners, I would say also focus on your personal finances along with the business.
Business.
That will reduce your concentration risk. That will increase the diversification. It will give you growth. It will give you liquidity. It will give you safety. It will give you optionality.
Okay.
So these four things I think are very important for them, and that is how I think they should look at it.
Okay. Okay. Thank you, Ketan, for sharing most valuable information and wisdom about the SME owners to create the wealth parallelly with business, to maintain their personal finances also is important rather than only being in business. So thank you very much. Thanks
You're
for
welcome.
coming.
You're welcome. Thank you.